What's up everyone, it's Caddy with MoneyVest. So markets here basically flat on the day, so not really going anywhere after a little bit of recovery from earlier in the week. So on Monday, Tuesday, markets pushing higher. Wednesday, of course, not a lot of movement, and that is primarily because of how we're seeing a little bit of that recovery after being very, very oversold. And now we're coming up to a certain resistance level that I want to highlight in this video and where we go from here, because we are very much in a downtrend. So I don't want to mistake this from kind of mentioning that this is a reversal. We're back up to all-time highs. None of that, because right now we're getting a little bit of an oversold, a technical rebound. And I'm going to highlight certain resistance levels to keep in mind as we move forward here with the earnings season as well, because Meta reported earnings, and of course the stock price is down over 12%. Losing over $200 billion in market value in just a little bit of a snap. And as a result, pre-market, we are slightly lower with the volatility here at the moment pushing slightly higher, up over 1%, back up to over 16. So again, nothing crazy, but we were obviously much higher at over 20 levels. So hope you all enjoyed this video and find it helpful. If you do, please make sure that you drop a like and don't forget to subscribe to the channel if you're just joining us for the first time. And again, for a few more days, there's limited spots left for our Patreon and for our Discord. There is a 16% annual discount, and you'll be able to access all of our members only private videos, including this one that I posted a few days ago, talking about the 30 stocks that I'm planning to buy during this market sell-off. Of course, we did see last week being very, very red. This week, we're seeing a little bit of a rebound, and I do have all my nibble prices, light buys, heavy buys, aggressive buy targets. Everything is mentioned in this video with over 30 individual stocks that I do feel have the most potential long-term in anyone's portfolio. So link's going to be down below if you want to join. And also, I did mention, a quick poll in our community. So I wanted to address this as well. This was just from a few days ago. I asked a very simple question from all the members. How many rate cuts do you expect in 2024? So how many rate cuts expected in 2024? You can also answer, pause this video and comment down below. How many rate cuts are you expecting in 2024? Or are you expecting rate hikes? Whatever you expect, let us know down in the comment section below. And basically, these right here were the reactions from everyone. So basically what we asked, how many rate cuts in 2024? React X if you expect a rate hike. 0 for 0, 1 for 1, 2 for 2, 3 for 3, right? We got 78 votes expecting at least one rate cut. And then surprisingly, 66 people expecting for a 0, meaning no rate cut nor a rate hike, and 13 people actually expecting for a rate hike here, right? 13 members expecting for a rate hike, and then of course 31 expecting for 2 rate cuts, 6 people expecting for 3 rate cuts, and then 2 more expecting for 4 or more rate cuts. But majority of people sit somewhere between no rate cut to as many as 1 rate cut. That is going to be a little bit over 130, 140 people of all the people that participated. And surprisingly, 13 members were expecting for rate hikes. Think of this as our very own FOMC, right? So what is the expectation from all the members? And the interesting thing is that if you did this poll, let's say 6 weeks ago, 8 weeks ago, the numbers would have been dramatically different. I can argue that majority of people, right now, what do we got? So 140 divided by 200, that is going to be percentage-wise close to about 70%. 70% of our members are expecting 0 to as many as 1 rate cut. And had we done this poll 8 weeks ago, I can tell you with a lot of confidence that 60 to 70% of members would have at least expected 2 rate cuts or more. And that's just how the markets have shifted, and that's just how the expectations have shifted among our members as well, because this is a small data set, but as a whole, we also make the market, right? All the members who participated also are part of the market, and you can kind of take this small data set, extrapolate some of the bigger numbers, and that's how the psychology or the mentality has shifted away from 3, 4, 5 rate cuts to now 0 to as much as 1 rate cut in 2024. And that's exactly what the market's also pricing in at the moment. So I just wanted to present this because it was quite interesting how we have shifted from 3, 4 rate cuts to now no rate cuts or as many as 1 rate cut, and some people also expecting a rate hike. Now, over the course of 2024, it's possible that this number starts to go up, right? So this 13, let's say, goes up to like 20, 25, 30, 40 as more and more people become a little bit more accepting of the potential idea that the rate hikes are also could be on the table depending on whether inflation comes down or not, whether it's sticky enough, whether it's elevated, whether it's stagnating sideways, or more rate cuts could increase. I mean, this number could go from 31 to as many as, let's say, 40 or 50 or 60. Again, a lot of that depends on just one thing, and that is going to be inflation. So meaning inflation, that is where a lot of those expectations are going to change. If inflation comes down fast enough, great. The Federal Reserve themselves are going to be more prone to potentially lowering interest rates because they don't want to hurt the economy and inflation's moving down to their target. But if it stays steady, if it stays stagnating, elevated, then I think the probabilities are going to diminish, especially when you are dealing with a very, very strong economy as well. So there was a comment from one of the top strategists, Paul Detrick. S&P may crash over 44%. So definitely a very, very negative headline. Selling early could pay off. And he does have a pretty strong track record. So B. Riley Wealth Management's chief investment strategist moved his clients out of stocks and into bonds in 2000, and from stocks to cash and bonds and gold in 2007. And he recalled in his April market commentary, and Detrick's clients missed out on the massive run-ups in stocks over the next year or so. This was back in 2007-08, but they also escaped the staggering blows from the ensuing collapses of the dot-com and the housing bubbles. And now he's suggesting that the stock market may be headed for a 44% crash, and getting out early could pay off. And they ended up netting about 7% before fees during the 2000 to 2000 recession, when the S&P was down over 49% and the NASDAQ had plunged over 78%, and they lost about 6% in the 2008-2009 recession, when of course the S&P was down about 57%. So that's definitely a significant amount of outperformance during times of distress and times when the markets were, just selling off quite aggressively. Now, this is his comments, latest comments from, just a couple days ago, based on today's market environment. And he says, and I quote, "Despite the fun and excitement of participation in the current Mardi Gras-like stock market bubble, completely untethered to any stock fundamentals, suppose an investor could miss most of 49 or 57% decline in the S&P 500 index and then get back into the stock market when the leading economic indicators and long-term moving averages indicate the recession is over." He emphasized that the quote-unquote wildly overvalued S&P would have to drop by 8% to return to its 200-day moving average, and the index has retreated by an average of 36% in the past recessions as well, which we already know that 36% is quite the average number of drawdown during times of recession as well. Now, there's nothing wrong with, of course, that type of analysis. I think many people would sort of argue that this market is indeed expensive and not really to a point where it's cheap or trading at an undervalued level. But I also don't believe that the markets are wildly overvalued. Yes, there's been a little bit of concentration. Yes, we're trading at somewhat more expensive price to earnings multiple, but this is nothing compared to what we saw back during the dot-com bubble or the housing bubble as well. Housing bubble, there were some very, very problematic systemic problems within the economy with respect to credit and, of course, debts and defaults. In the dot-com bubble, of course, the valuations were way, way higher compared to the actual revenues and fundamentals of businesses. Now, I believe we are in a far more stable, more established market environment, given that economically, the economy is so strong despite the higher interest rates, and not to mention the company's earnings are also coming in very, very strong. Meta reported their numbers today. They doubled profit. Tesla also reported their numbers. So consumers still strong. Not saying that they're not strong. They're very, very strong and incredibly, sort of wages are good, unemployment's low. So there's a lot of indicators that are suggesting the economy is very good. Is that going to be the case 6 months later, 8 months later, 12 months later? No, and nobody has the answer to that. So just to sell on this idea that the markets could crash 44%, I'm not that type of an investor anyway, because this is like really just timing the market to try to avoid some type of an event that may or may not happen, right? So you're really just kind of making a decision on something that may or may not happen, and the probability of that happening is also really low. So even though, yes, he may have some sort of a weight to his analysis and his ideas that the S&P could crash 44% or whatever, but just kind of like betting on that idea also results in missing out on the potential gains or the upside that the market carries, which at the most of the times, if you look at the long-term trends and the averages, markets tend to move higher as productivity and earnings and everything grows. So really, I think the better approach here is to look at the markets today in the present moment and understand how favorable the risk reward is. Do I need to be deploying more cash? Do I need to pull back a little bit? Do I need to start sort of hedging by selling calls? And what's the best approach instead of just like selling stocks straight up in panic? And of course, waiting for that 40% crash and then getting back in, because that is kind of like timing the market, which is incredibly difficult and almost impossible to do on a consistent basis. So instead of worrying about that, I think the much better approach is look at the risk reward, look at the valuations, look at the fundamentals of businesses that you want to own for the long term, and are they in a better position to survive that storm and of course come out stronger on the other side. And at the end of the day, market selling off is always a buying opportunity. As I've always mentioned, that markets coming down, prices coming down are nothing but discounts and deals for us to get back in, for us to buy more, for us to be a little bit more aggressive in our dollar cost averaging. So hope that makes sense. But markets here, of course, on the day, Apple pushing higher, Google pushing higher, Tesla, rallying over 12% after earnings, NVDA was slightly down, Amazon was slightly down, Netflix was selling off almost 4%, and more importantly, Meta obviously selling off quite aggressively after hours, which we'll take a look at. And again, this right here is the performance. So defensive, utilities, and cyclicals doing much better. Financial, industrial, and healthcare pulling back. In the last 1 week, we have seen some outperformance on utilities and financials and defensives. So markets have a little bit rotated out of tech over to other parts of the market. In the last 1 month, it's been very, very clear how money has come out of technology, out of cyclicals, and has moved into energy and utilities and a little bit more defensive parts of the market. Volatility slightly higher, cocoa prices, copper prices pushing higher, with lumber prices selling off quite aggressively. And this right here, again, is Bitcoin just trading under 64,000 and Ether just over 3,100 as well. This right here is the volatility. And right now we're at 16.2. So this is the current level. And you'll notice that we are in the 39.9 percentile, so just under 40 percentile. Still a very normal reading. We did get up to as much as 22. So if you come over, we were somewhere around here, which basically put the volatility in the 75 to as much as 80 percentile, right? So this right here is where we were just a few days ago. And again, the higher it goes, the better the opportunity becomes for us to buy, because that's how it's getting greener and greener. And of course, if it gets up to 76 to as much as 81 levels, then we are pretty much at the topmost percentile, 99.9%. And that would be one of the most rare things that happens in the market, i.e. one of the best buying opportunities, and to dollar cost average into the S&P as well. So this earnings season will reinvigorate S&P 500, so record 63% of respondents expect financial results to support stock prices. As I mentioned earlier, I think the expectations are quite solid, and the companies are also beating expectations, which is good because of how strong the consumer spending is. And hedge funds have also started buying as stocks trend lower. S&P 500, of course, seeing a drawdown of over 5% as a technical level. And this right here is the entire sellout that we're witnessing, with a drawdown, of course, of over 5, almost 6%, which again represents what? Buying opportunity. Buying opportunity. Mentioned this a couple of times in our Discord. That's exactly why I wanted to do this video of how it is now very good, favorable risk reward ratios to start buying, start nibbling, start putting money to work. So that is going to be the game plan here. Higher yields haven't been bad for US stocks. Now, a lot of people have been questioning the yields, of course, been pushing higher, so 4.5, closer to 5% now. And this right here is the S&P 500's average annualized performance based on the 10-year Treasury yield range. And what you'll notice is that greater than 6%, S&P 500's average annualized performance still tends to be much, much stronger. But what they have not highlighted here is in times of recession. When there is a recession and yields are, let's say, higher, then the performance obviously is much worse, because during times of recession, unemployment's higher, earnings are lower, and that's what the market starts pricing in, and we start to see a little bit of a sell-off in the market as well. So again, that will be a buying opportunity. Every sell-off is, in my opinion, a buying opportunity. Nothing to, of course, shy away from, but just be understanding of the fact that every sell-off, market drawdown, market selling pressure is time for us to start looking into buying opportunities again. Volatility here, keep it close at 15.3. Of course, we're coming down from those high levels of 21, 22. Of course, my target's going to be up to 23, all the way up to 36.40, and those right there are going to be some of the best levels to keep in mind for volatility. Talking about Bitcoin, just consolidating sideways in between that range of 61.8 to as much as 72.2. And Ether also just consolidating sideways between the 3,100 to as much as 3,700 on Ether as well. So a lot of consolidation sideways in between that range for both of these cryptocurrencies. Coming over to crude oil, we're seeing a little bit of a bounce back higher from that support of $81 a barrel. Resistance up to $87.50 to as much as $88 a barrel. And we're seeing, again, a lot of consolidation sideways for crude oil. And that, again, is going to be a level to keep in mind for crude oil at the moment. Now, coming over to S&P 500, and this is what's interesting, and I really want to highlight some of the levels to keep in mind. So if I come over to the 30-minute time frame, what you'll notice and witness here is we weren't able to break out of this resistance. So this is a more of a short-term level to keep in mind. So if I highlight that, so if you sort of come back, this level previously acting as a bit of a support. So all the circles you see, very good support level. And then, of course, this is the red line. This is 5,081. You'll notice that recently, as much as April 16th, 17th, we got rejected at those levels a couple times, sold off, broke down even further, and right now we're kind of struggling to break out above this level as well. So really moving forward in the next couple days to as much as couple weeks, I really want you to watch two levels on the S&P that you need to watch for a potential reversal in the overall trade here on the S&P, and that's going to be 5,080 to as much as 5,110. That's pretty much the range within which, if the S&P can break out, there's potential for us to retest highs of, let's say, 5,100, 5,160 to be precise. That's going to be that next target. But right now we are very much in a bit of a downtrend for the S&P. So we're still making lower highs and lower lows. I want to be very clear that we're still in a downtrend. Just because we rallied Monday, Tuesday does not mean that this is a start of a reversal, or this is, we're already in that confirmation for the markets to push higher. We need to be patient. We need to wait for that reversal to take place. But again, the risk reward is getting better, and it's only going to improve from here if the markets sell off even further. Talking about the NASDAQ, same exact thing. The level to keep in mind right now is 15,850 to 15,900. So this right here, very, very important level to keep in mind on the NASDAQ. Previous support acting as a now potential resistance. And right now we're just consolidating sideways. We're not able to sort of break out of that level, and right now still in a bit of a downtrend, lower highs and lower lows. We were very, very oversold. That's exactly why we did see a bit of a bounce, 3.5–4% bounce on the NASDAQ, and S&P also recovering a little bit from those lows, pushing up over 2.2 to 3%. But again, nothing has changed yet. We're still in a bit of a downtrend, still waiting for that confirmation and breakout above certain resistance levels. Talking about Apple now. So Apple on the day also pushing higher very nicely. So a little bit of rebound, so 1.2%. Pre-market flat, target and resistance still back up to $199 to $200. And of course, if it ends up breaking down further, the next level is going to be inside this green rectangle, sitting between 152 and 153 for Apple. So that right there, previous resistance, is going to be acting as that next best support for Apple moving forward. Talking about Amazon here down 2% on the back of Meta earnings because of their advertising model. So Amazon definitely has a little bit of that advertising component. Of course, Meta is pretty much advertising, but Amazon has that component of advertising as well. And as a result, Meta platform drags mega cap lower on higher cost forecast as well. So I'll break down Meta earnings in a more detailed, more dedicated video. So I have Inphase and Tesla and Meta to catch up to. And then of course we got Microsoft and Google also reporting very, very soon, along with Apple and Amazon also reporting very soon as well, probably next week. So support level for Amazon is going to stay put down to 170, 171, resistance all the way up to 188 for Amazon. Talking about Tesla, and Tesla definitely did have a pretty decent day. Pre-market basically flat, and the next target and resistance is going to be 177. But I really, really want to help you understand how much indecision Tesla went through. This is a very, very strong doji candle. So you can see a very long wick to the upside, very long wick to the downside. The body is really, really slim. And that just is very suggestive of how indecisive the markets were for Tesla on the day of earnings, after the earnings, right? So this right here is just telling us that the price action was kind of like in this tug of war between the bulls and the bears. We got up to as much as 168, we got down to as much as 157, and we kind of settled right in the middle at 162. So there was a lot of back and forth here for Tesla. So it doesn't give us a very clear idea of whether this is bullish or bearish, because the doji candle is indecisive to begin with. But of course, a little bit of a gap up does suggest there was, on a net basis, some optimism around Tesla earnings, but next target and resistance is going to stay put at 177. So this right here, a very, very important level to keep in mind for Tesla, needs to break out above this level in order for us to at least retrace back up to 204 and 205. That's going to be that next target. Talking a little bit about NVIDIA now. So NVIDIA on the day selling off and getting rejected at that $845 level. If I bring out some of the moving averages, the 21 and the 50 EMA, you'll notice that we have already been breaking down below the 21 EMA. We're still kind of tagging that level. Even yesterday we got up to as much as 837. We weren't able to break out and we sold right back down. So support level is really going to be staying put at 741. So that is going to be that next level to watch. And unfortunately, as you can already see, that NVIDIA also is in a little bit of a downtrend, right? So it's making lower highs and lower lows, as you can already see. It's not going as high as it did the previous time. So boom, 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 3 lower highs, and then boom, boom over here, lower lows continues to form on NVIDIA. So a little bit of a downtrend for this stock as well. Advanced Micro Devices is finding some support here in the 147, 150s, but of course not able to recover higher. But we did see some L3 banker oscillator suggesting for some buying momentum here, as this was a pretty big yellow candle coming in. So there is possibility for institutions starting to kind of buy a little bit of AMD here. So this is definitely new, because usually when we start off these positions, they start off with the yellow candles and then it kind of accelerates with that buying momentum. So we are seeing that. That's actually pretty nice to see that AMD is getting bought up here, and there are some of the bigger orders coming in considering how oversold it is. And of course, from its all-time highs, AMD is down quite a bit. So from 226 down about 33%. A third of its market value, and of course support level is going to stay put roughly here at 147, 148, resistance all the way up to 164 for AMD. Talking about PayPal here, and PayPal on the day also moving higher a little bit. Resistance going to stay put roughly at around $65 with a double top resistance and supply in $68, $69 per share. And right now we're kind of inside this consolidation pattern. Support level staying put at $57, $50 for PayPal. Talking about Visa, and Visa also reporting earnings, strong beats on EPS and revenue, selling off entirely on the day. So it was gapping up to as much as 282, and then of course selling off intraday. Support level is going to stay put down to 265 for Visa, resistance and targets up to 291. I do believe that Visa may have a little bit more potential downside, but again, I've got the earnings to catch up to, and I will be doing a more separate, more dedicated video on Visa as well. Talking a little bit about Meta platforms, and Meta here selling off, breaking down in one single go, down about 13%. Pre-market, it's got a gap. I mean, he left the gap on the upside. Now it's going to leave a gap on the downside, and I'll go ahead and turn this level into a resistance. Now, I do believe that Meta could get bought up here intraday. I think with a huge gap down, there's possibility for Meta to get bought up here intraday and kind of get back up to, let's say, 430s and 440s, potentially getting up to this resistance, 450s, to retest some of this level, but support level next is going to be down in the 386 for Meta. And again, strong beats on EPS and revenue. We'll be doing a more separate, more dedicated video on Meta as well. Talking about Netflix here, Netflix also coming down a little bit. Resistance going to stay put at 594, kind of aligned with those moving averages and that resistance here. Support is going to be at 536, along with this huge gap that Netflix needs to fill. So it may or may not get filled here for Netflix, all the way down to as low as 473, 474 for Netflix as well. Talking about Google, and Google here also coming down 2.7% on the back of Meta earnings. So that is very common, very obvious, as it's also a very, very big advertising player. It was already overbought here, so I wouldn't be surprised if Google sees some more potential downside, considering that it has already rallied quite a bit. It's actually one of the only companies right now that is doing much better, among all Magnificent Seven and large cap tech stocks. So support level is going to stay put somewhere around this $150, $151 per share. And finally, we come over to Microsoft among big tech here, pulling back, bouncing off of that support as we discussed. Pre-market down 1.7%. Resistance is going to stay put at 417 with a little bit of a demand here inside this green rectangle. And of course, a breakdown below this could send us in the 360s for Microsoft as well. Enphase Energy, after the earnings, did sell off over 5.5%, despite actually missing expectations here quite significantly, and of course missing revenue expectations as well. Support level is going to stay put at 106, and we did get a bit of a bounce back higher from those levels, but Enphase does look pretty weak here in the hundreds, so I wouldn't be surprised if it does get a breakdown below this level, and $92, $93 is going to be next to watch as a support on Enphase. And finally, we come over to Costco, and Costco here consolidating sideways, resistance all the way up to 750, and a support level at 705, all the way down to 678 for Costco as well. So those right there are going to be some of the levels to keep in mind. S&P 500, NASDAQ getting back up to those resistance levels, so very, very important for us to keep in mind that we're not out of the woods yet. We're not out of the woods yet. We still need to wait and see whether we get a breakout, and a resistance beyond that level is going to be much, much higher. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us. And we'd love to have you on board. 5 more days left, and you can access all the members-only private videos, including the early access to the beta launch when we do have that for the MoneyVest software. As always, happy investing. I'll see you all in the next